All right. Good morning, everyone. We'll put the chat up to so you can drop a comment in there as we go. See a couple people already commenting. Good morning, team. Good morning, everyone. As always, we will wait just a couple of minutes here, let everybody have a chance to jump on, and also give us a chance to go live on all the different platforms. We stream this on not only YouTube, but Facebook and Instagram and LinkedIn. And so we going live on all the different platforms. All right. Good morning to the people watching on LinkedIn as well. Everybody on YouTube, Facebook, Instagram. We appreciate everybody tuning in. We're just waiting a second to get started here. Let everybody have a chance to jump on and get live on all the different platforms. All right. Looks like we are good to go. Let's go ahead and get it started here. So, welcome everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do here on this show every weekday is go through the rates for some of the more conventional type programs, as well as some non-QM programs. And then we do a deep dive into a different topic every day. Now, today's topic is definitely something that's familiar to us at the Mortgage Calculator and our team, since we specialize in non-QM loans and investor products. We do a lot of commercial loans. So our deep dive today that Jose is going to go into is going to be commercial loans. But before we do that, like we do every morning, we're going to go ahead and pull up the rates with our pricing tool, and we will go over the actual live rates for today. So Nick, go ahead and pull up our pricing tool, share your screen, and let's see what the rates are doing today.
All right, let me go ahead and take over and switch my screen and we'll get started. So as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. We have over 300 licensed loan officers in 22 states for primary second homes, and we can do our business purpose or commercial loans, which will be the topic for later today, in 44 different states, so pretty much every state. So please get with our team if you'd like a full loan estimate and a full breakdown. This pricing tool will show us the general rates and APRs for the general programs. It is April 14th, just after 11 a.m. Eastern. So all of our programs are live now. So we're going to set up a basic scenario and run through a few examples as we do every morning. So for our scenario, we're going to keep a 400,000 loan amount. We are going to always set a 80% loan to value. So 80% loan, 20% down payment. We're going to set desired price to 99. That means we're going to ask the computer to find the best rate at one discount point in cost. Pretty much all of our customers today are requesting one discount point or greater in buy down. So therefore, that is our most common request and what we will present today. We're going to go through our options here. Conforming conventional options will be first. Then we'll present our FHA options. And then we'll go into our non-QM, aka expanded guidelines here, which will allow us to use alternative income. We do not do the VA live. That's only for eligible veterans. We appreciate your service and would be happy to quote it, but since not everybody's eligible, we don't do that live. And same with USDA. That is only for properties in a USDA eligible rural area. If you do happen to be shopping in one of those areas, let us know. We'd be happy to quote it for you. But let's start with our conforming conventional. For all of our quotes, we'll set it up as a purchase, 30-year fixed loan, primary occupancy, single family house, 1 unit, state of Florida, county Miami-Dade. That's where our office is. And for all of our estimates today, we'll use an estimated FICO score of 760 and an estimated debt to income ratio of 40. So let's check out our rates this morning. Little bit up from yesterday. Usually Fridays do see some upward momentum to basically cover for the weekend. So this is a touch higher, 6.375 rate at 1 discount point in cost and an APR of 6.551. Remember, the APR allows us to compare across programs. So as we compare these different options, please key in on the APR here, 6.551 for our conventional programs. So now let's go back into our pricer and pull up the same exact scenario. And this time we'll select FHA. So many times if a customer doesn't qualify conventional, usually the first option, FHA does allow a little more leniency on the credit items and a much higher debt to income ratio we can use. So typically that's the next option. So everything else will stay the same here. Let's check out our FHA rates this morning to compare. So again, a little bit higher than yesterday, I believe. Right now, the best combo the computer found, 5.625 rate for 0.875 discount points in cost for 6.223 APR. So just a slight tick higher than it was yesterday. Definitely recommend everybody out there shopping compare the FHA and we're about to present the non-QM to the conventional. Always are very comparable. And actually in this scenario, you see the FHA APR 6.223, slightly lower than the conventional. In the past few years, it's always been the opposite, right? FHA is typically higher, but in this scenario, and with the recent reductions in the yearly or the paid monthly mortgage insurance, that allows us to actually beat the conventional APR in this scenario. So definitely recommend people check out both options. For now, if our borrower for any reason doesn't qualify for conforming or FHA, let's set up the same scenario. And many other banks and lenders do not have any other options. Besides that, fortunately at the Mortgage Calculator, we have over 5,000 additional loan programs under expanded guidelines, aka non-QM. Everything else will stay the same, but you notice we have new options pop up here for income verification. So typically we wouldn't use a full doc. That's what we have to use for conventional and FHA. So that's 2 years of tax returns. So typically we would choose non-QM in order to use an alternative income documentation, such as 1 year alt doc, 2 year alt doc. We can even do asset related programs with no employment at all. Business bank statement programs are very popular. Our investor DSCR programs are very popular. We even have 1099 programs, P&L programs, etc. But our most popular program by far is going to be our personal bank statement 12-month for a primary home borrower. And that's going to be for someone that is self-employed. Many times our self-employed borrowers have various write-offs on their tax return. And so when we use the 2 years of tax returns, sometimes their income isn't where it needs to be in order for the home that they're looking to purchase, or they don't even qualify at all. Now, in this case, we can use 12 bank statements, the most recent 12 bank statements, to determine a debt to income ratio using those bank statements instead of their tax returns. Therefore, for most of our customers, they qualify for much more income using those cash bank statements and therefore qualify for the home of their dreams and are able to execute the transaction. So we'll see some higher rates here on the non-QM, but remember, these are solutions, right? For a borrower who would not otherwise qualify or needs to qualify for more income and use alternative income to get that more income. So let's check out our bank statement rates this morning. So good options here. The computer has a bunch of different programs right at the same price, it looks like. Yep, they're all right there. So 7.125 rate for 1 discount point in cost for a final APR of 7.205. So remember, conventional was just over 6.5. Here we have a non-QM solution that is just over 7. So very comparable. We love to give all of our options to our borrowers so they can compare which program might fit best for them. And under these non-QM programs, if you notice we scroll down, there's hundreds of different versions of these. Some of these may allow things like a recent bankruptcy or foreclosure and other credit events. And there's all kinds of different flavors of these programs as you scroll down. So please get with our team and we'll find the one that fits best for your exact scenario. Now, before we go into Jose's commercial deep dive, we always want to touch on the live mortgage rates for investment properties. So we're going to do 2 more examples. We're going to select investment property occupancy and set this up the same, 80% loan to value, 20% down payment. And we're simply going to compare our 2 options. We have conforming conventional options and we have our non-QM expanded guidelines options. Remember, FHA, VA, and USDA are not eligible for investment properties, so we're simply going to compare these two. So we'll select conforming. Everything else will stay the same as all our other examples. All we did was change to investment property. So let's check out our investment property rates this morning. Always keep in mind that the GSEs, Fannie Mae, Freddie Mac have added additional loan level price adjustments to these programs. So unfortunately, the computer's not able to find a rate at one discount point in cost. The best combo for APR here the computer found was a 6.75 rate for 3.125 discount points in cost, and a final APR just under 7 at 6.997. So still a great APR, still a great rate, but many of our investors would rather deploy this, in this case, this $12,000 of discount points into another investment property, rehabbing another investment, etc. So many of our investors ask for a higher rate or a different program in order to reduce the discount points. And unfortunately, under conventional, even if we scroll down here, there really isn't that many options to go up in rate. Here's a decent one, 7.5 rate for 2.125 discount points. But we love to present our non-QM options as the solution to that problem. So for our final demo, let's go back to the quick pricer, set up the same exact scenario, set up investment property, and we will choose non-QM expanded guidelines. Now, when we choose this option, there are two pop-ups that come up. First, income verification. As I mentioned before, our most popular option for an investment property going to be our DSCR program. That's because it doesn't actually require any income from the borrower or any employment from the borrower. We're simply going to use the estimated rental income from the property to determine if that covers the mortgage expenses, the PITIA of the mortgage we're proposing here. If the DSCR is 1 or greater, that means the property cash flows and the cash or the rents will cover the expenses. We even have options for a DSCR ratio under 1, meaning the property doesn't quite cash flow. So here, for this example, I'm going to put 1.5 just so we can get all the good programs to pop up, which means a property cash flows very strongly, but we do have options for under 1 as well. Now, the other option we always have to select on a non-QM investment property is a prepayment penalty. It's standard. We always select 3 years. That is standard for these programs. However, if a borrower chooses so, we can select 0. That will reduce the number of programs and cost more money, so we don't suggest it. And we could select 5 years. However, that will reduce the number of loan programs. It will cost less money. But for our examples, we always choose 3 years because that is standard. So let's check out our DSCR rates this morning. Oh, I think the ratio is not picking up. Let me go back. So the ratio is a new thing that they just put out today here. So let me see if I can get this to work. And see if we can leave this blank to get the more options. Only some of the programs are using the new box there. No. Might have to wait until all the options. Yeah. I guess we'll have to wait to show these until all the options start using the new values that we have, unfortunately. Yep. So only one of our options are using that new value. Still a great option, though. 7.5 rate for 0.85 discount points in cost and a final APR of 7.575. So that's a great option. There are hundreds of these, I promise, if you guys are seeing the show every day. But this is a new option they just released today to select the DSCR on the pricing program here. So that is probably our best rate option. There might be one that's a touch better, but this is a great option to present. Now, let me go ahead and switch my screens and we'll get ready for Jose's deep dive here. All right. So for today, Jose is going to go into a deep dive example on a specific product as we do every day. This time it's going to be on a true commercial property loan. We've been talking about different variations of commercial property, so I'll let Jose present, I don't know which type of commercial property he's presenting, but this is different than our last 3 episodes that we've done, which covered 5 to 8 small commercial. We covered mixed use 2 to 8. And then we also covered basically an 8-unit plus large residential only. This is not any of those three, right? So I'll go ahead and let Jose take over and define what we're talking about, and then we'll pull up your examples if you're ready.
Absolutely. Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Commercial has many connotations, right? We think, okay, commercial is multifamily, commercial is retail, commercial is mixed use. Basically, we look at as commercial anything that's not residential, right? So we have covered quite a few commercial options with our SBA, multifamily that we were doing yesterday, for example. Today, we're going, like we like to do, really outside the box here. Now, keep in mind the quotes that I'm giving now are not an all-encompassing only option that we have, because we would need a specific deal to give you, truly specific options. What I'm trying to show here is 4 different commercial type scenarios, just to enlighten you, give you more context of what is available out there as far as commercial loan options for our potential borrowers that are out there, and for our mortgage loan originators that are out there as well. So first option that I have here is a retail purchase. Now, this is an 80% purchase option. Now, keep in mind, this is a commercial, but normally a retail option could, if it's an owner-occupied space, would probably go via an SBA route, right? Small Business Administration route. If you're an owner occupant occupying at least 51% of the space, the SBA would probably be your best option there. It would be the lowest out of pocket as far as down payment. With SBA, if you are currently occupying a space similar to the one that you're going to be buying as a tenant for your business for the past 2 years, it is possible, obviously subject to meeting the requirement, but it is possible to finance 100% of that purchase for SBA. So this is not an SBA show today, but I'm just letting you know what is out there, because when you're looking at these commercial options now and you're running scenarios through your head, keep in mind, if owner occupied at least 51% of the space, the best option is usually going to be SBA. However, for those scenarios that are not owner occupied at least 51% of the space, then if it's a true investment option, then you would be going with these commercial options similar to the ones that I'm proposing today. So here we're looking at the purchase of a retail space. That could be any type of retail space, a store, storefronts usually, however it's set up, whatever the guidelines are that ask you to conform for a property type. And in this scenario here, maximum loan to value is 80%. Now here I'm giving you the scenario of a 5-year fixed amortization loan, which then converts to a 1-year adjustable rate mortgage. Keep in mind that 30-year fully amortizing is available at a 0.25 additional rate adjustment, not point adjustment. Now, when you're looking at commercial properties, you gotta note that they will classify the properties in tiers. You're gonna have your tier 1 properties, which are gonna be the more favorable one. Tier 1 properties would be, for example, this retail would be tier 1. Multifamily would be tier 1 as well. So tier 2 properties are going to be some of the ones I'm going to show you in a second. Would be like automotive, light industrial, something where there could be a riskier component to the property type or to the rental type. Restaurants are also tier 2 properties. In some cases, restaurants are no tier properties. They're not even doing them. As we all know, after the during the pandemic and after the pandemic, restaurants took a hit in terms of favorability amongst lenders. So here we have 80% option and at 10.125. No additional points on this, and I am pricing this out as a borrower pay transaction, as is common for most commercial loans. Now, it is possible in some commercial options to have split compensation. What does that mean? That means that you can discuss with your borrower to see what they prefer. Does the borrower prefer to include some of the compensation that you're going to be paid from the interest rate and some coming from them as borrower paid? So you'd have some lender paid and some borrower paid. Or does the borrower strictly want all the compensation to be borrower paid? If you choose usually an additional point in yield spread, then it could be anywhere 0.35, 0.5 of an extra percent in the rate. It really depends on the option. So remember, tier 1 properties and tier 2 properties. So in our next example here is going to be a nice example of a tier 2 property, which is an automotive repair facility. In this case, keep in mind also, I was mentioning that tier 2 properties have a 5% LTV adjustment. So that means to the downside, not to the upside. So whereas their max LTV on most of these programs would be 80%, the max on a tier 2 property is 75%. But still, you're getting good rates here, 10.375, and that is best no points. And one other thing to note is loan amounts. Typically, when you go above $500,000, at least with this particular option here, there may also be LTV adjustment of 5%. So keep that in mind. So this is for an automotive repair facility. Now, automotive repair facility also could be something that could be SBA as well. If you're the owner of the place and it's going to be your automotive repair facility, SBA. Keep in mind also, for this type of loan, you're going to be required a phase 1 environmental study. They're pretty expensive, $3,000-$4,000. And if any type of potential issue comes up on that phase 1 environmental study, then you're going to have to do a phase 2, which is going to be more in-depth samples of soil and all this kind of stuff. It's going to cost a few $1,000s. So keep in mind the potential pitfalls that you do incur when you have one of these automotive repair facility or light industrial type loans. So with that being said, here we have our light industrial type option, 70% LTV option for this one, because our loan amount is $1,050,000. So if we were at a $500,000 loan amount or below, we could do 75% LTV, excuse me, on this light industrial purchase. In this case, we can go 70%. 10.875%, and this is a borrower pay transaction. No additional points here. All of the adjustments with this commercial conduit are rate adjustments, so you're not really going to see any points. The only points paid would be our compensation. And now this is our last option here that we get a lot of requests for. Self-storage facilities. That's like the rage.
That's
right?
all the rage with the investors. You should have done the RV parks. We do have the RV park option.
That's another one. I was just thinking about that right now as I looked at self-storage. We do have the mobile home facilities, which are going to be in the same rates, same LTVs to 75% max, because the mobile home / RV park is a tier 2 property. So in this case, you can tell that they like those self-storage
So is
facilities.
self-storage a tier 1 then in this case, it sounds like?
Yes, sir.
Gotcha. Okay. Gotcha.
So here we're looking at 75% LTV because my loan amount is $750,000. So pretty good option here. Keep in mind here, this is just to create the awareness of what the different types of commercial loans are. These are all quotes were derived from one of our sources that we have, but we have many more sources available, because keep in mind, these commercial loans are very subjective, right? You got to give them a zip code, property address, and then they're going to start vetting the property, vetting the neighborhood, vetting the city, vetting the state, whatever they feel that they got to vet to properly assess the investment, right? This is not like a residential loan where they can't do any of that stuff because it would be considered discrimination. Commercial is commercial. There's no protections there to the individuals.
No rules.
Right. Right. So let the buyer beware in those situations, right? You got to be very well aware, as well as for our loan originators out there, when you are doing these commercial deals, mind you, we have agreements with all of these conduits, so we're not going to have any issues like that. But you do got to be aware that sometimes in the commercial world, get your agreement in writing from whoever you're working with to make sure that they do not somehow or another cut you out of the deal, because that can happen, especially when you're looking at a big dollar amount. Be aware of that. But at the Mortgage Calculator, all of the options that we offer are options that we have that we can offer in-house, either through our commercial broker conduits or our in-house conduits. So no worries there.
Yes, sir. Looks like we do have a question about the environmental. Great question here, directly to the point here. So is it I'm guessing you said, is it standard for the buyer or the seller to pay the environmental study required for the loan?
That is strictly buyer paid. Due diligence is what they would call that in the commercial world, your due diligence period. So in the commercial world, due diligence periods tend to run longer than in the residential world. Where in the residential world, depending on the market that you're in, an inspection period typically would be 10 days, 15 days if you're in a slow moving market, 5 to 7 days if you're in a brisk moving market. In the commercial world, due diligence period could be 30, 45, or 60 days. Because if you're doing one of these purchases that you're required a phase 1 and potentially a phase 2, you need time. Because it takes time to get the report, time to do it, time to get it back, time to assess it, and then go back for part 2. Underwriting, you may have to turn this stuff into. They're going to come back to you. So you won't, you need the extra time to be able to either, accept, negotiate, or cancel the deal based on any issues that may come up.
Great question there. All right.
Great question. Yeah. I don't see anything else, so we can go ahead and wrap it up here. Great info there, Jose. As I was saying earlier, we specialize in non-QM and investor programs, and of course, a lot of our investors do these commercial loans. So as Jose said, definitely something that we are familiar with. And we do have over 300 loan officers. We are licensed in 22 states across the country, but these commercial loans we can do in any state. Right. So feel free to contact us. You can visit us at themortgagecalculator.com to connect with one of our loan officer consultants that can consult you and walk you through whatever transaction it is that you're looking to do. As Jose said, these commercial products are very specific to the actual property. So get with one of our loan officers, talk about the property, start getting the info and getting the ball rolling. You can also email us at info@themortgagecalculator.com. We do this show every single weekday at 11 a.m. Eastern time, where we go through the current rates and then we do a deep dive topic like we did today with commercial loans. So thank you, Nick. Thank you, Jose. Thank you, everyone, for tuning in. And we hope to see everyone on Monday at 11 a.m. Eastern for the next show. Everybody take care. Have a great day.
Thank you, everybody. Have a great day.